Assalamualaikum warahmatullahi wabarakatuh. My name is Puspita Dewi. I am from Clas Accounting B. Debit and credits. Debit and credits definition. Business transactions are events that have a monetary impact on the financial statement of an organization. When accounting for those transactions, we record number into account where our debit column is on the left and the credit column is on the right. A debit is accounting entry and either incurs an asset or expense account, or decrease a liability or equity account. It is positioned to the left in an accounting entry. A credit. In accounting entry that either incurs a liability or equity account or decrease an asset or expense account. It is positioned to the right in the accounting entry. Debit and credit usage. Whenever an accounting transaction is credited, at least two accounts are always impaired, with a debit entry being recorded against one account and a credit entry being recorded against the other account. There is no upper limit to the number of accounts involved in a transaction, but the minimum is no less than two accounts. The total of the debit and credit for any transaction must always equal each other, so that accounting transaction is also said to be is balanced. If a transaction were not in balance, then it would not be possible to create financial statement. Thus, the use of debit and credit into column transaction recording format is the most essential of all control over accounting accuracy. There can be considerable confusion about the inherent meaning of a debit or a credit. For example, if you debit an cash account, then this means that the amount of cash on the increase. However, if you debit an account payable account, this means that the amount of account payable liability decreases. This difference arises because debit and credit have different impact across several broad types of account, which are asset account. A debit increases the balance and credit decreases the balance. Liability account. A debit decreases the balance and a credit increases the balance. Equity account. A debit decreases the balance and credit increases the balance. The reason for this seeming reversal of the use of debit and credit is caused by the underlying accounting equation upon which the entry structure of accounting transaction are built, which is asset, liability plus equity. Thus, in a sense, you can only have asset if you have paid for the liability or equity. So, you must have one in order to have the other. Consequently, if you create a transaction with debit and a credit, you are usually increasing an asset while also increasing in liability or equity account or vice versa. There are some expansions such as increase one asset account while decreasing other asset account. If you are more concerned with account that appear on the income statement, then this additional rule apply. Revenue account. A debit describes the balance and a credit describes the balance. Expense account. A debit increases the balance and credit decreases the balance. Gain account. A debit decreases the balance and a credit increases the balance. Loss account. A debit increases the balance and a credit decreases the balance. If you are really confused by this issue, just remember that debit always go in the left column and credit always go in the right column. There are not exceptions, debit and credit rules. The rules governing the use of debit and credit are as follows. All accounts that normally contain a debit balance will increase in amount when a debit left column is added to them and reduce when a credit right column is added to them. The types of account to which this rule applies are expense, asset, and dividend. All accounts that normally contain a credit balance will increase in amount when a credit right column is added to them and reduce when a debit left column is added to them. The types of account to which this rule applies are liability, revenues, and equity. The total amount of debit must equal the total amount of credit in a transaction. Otherwise, an accounting transaction is said to be unbalanced and will not be accepted by the accounting software. Debit and credit in common accounting transaction. The following bold point note the use of debit and credit in the more common business transaction. Sales forecast. Debit the cash account, credit revenue account. Sales on credit. Debit the account receivable account, credit revenue account. Receive cash in payment of an account receivable. Debit the account, credit the account receivable account. Forecast supply from supplier forecast. Debit the supply expense account, credit the cash account. Forecast supply from supply on credit. Debit the supply expense account, credit the account payable account. Forecast inventory from supply forecast. Debit in inventory account, credit in the account. Forecast inventory from supplier on credit. Debit the inventory account, credit the account payable account. Pay employees. Debit the wage expense and payroll tax account, credit the cash account. Take out a loan. Debit cash account, credit loans payable account. Repay loans. Debit loans payable account, credit cash account. Thank you.